3 months ago, I talked about why reacting emotionally to market declines can be so damaging. And we didn't have to wait long to see why. Markets recovered quickly, and once again, the recovery began before investors had any reason to feel completely comfortable. And that's the theme of this quarterly review. The market does not wait for you to feel better. By the time the headlines improve, uncertainty fades, investing feels comfortable again, a significant part of the recovery may already have happened. So today I want to do two things. We'll quickly look at what happened, but then I want to zoom out into what I think is a much, much more important lesson. The path to long-term returns never feels as smooth as the end result may seem to look. Even when we're looking at an annual basis of returns that the market gives us, the route there is often very volatile. So let's start with the numbers. For the past year, so mid-2025 to mid-2026, Canadian stocks have returned approximately 32%, US stocks 27%, international about 25%. On the fixed income side, Canadian bonds up around 3.5% and global bonds around 1.5%. And there is a lesson there with currency risk and things like that, but I'm not going to get into that now. But it does show why I want Canadian bonds in my war chest. The exact winners and losers will change depending on whatever period that we're looking at, and that's very normal. Different markets lead to different things. One of the dangers of reviewing performance too frequently is that we start treating recent returns like they tell us what's going to happen next, and they do not. A quarter can tell us what happened recently, and a longer period gives us some type of context, but neither gives us a reliable forecast for what is going to happen next. So as always, we need to plan around that uncertainty. I came across this chart and I thought I would share it. It's a great way to explain the difference between how people imagine investing to be versus what it actually feels like. The dotted line is the ride that most people would like to experience. It's a straight, steady experience, climb upwards, up and to the right. But the solid line is the reality. There'll be sort of quick negatives, followed by quick ups, followed by quick negatives. It's very choppy along the way. There's small gains, small losses, sudden drops, recoveries, uncertainty, and there's periods where it feels like absolutely nothing is working. In this example, the market fell negative before recovering and finishing the period up 8.5%. Nobody experiences the dotted line. We experience the solid line. We experience the uncertainty, the headlines. We experience the drawdowns while it's happening without knowing whether the next move is up 10% or down another 20%. And that's the part that often gets lost when we talk about long-term returns. You do not get the long-term returns without living through the short-term discomfort. Yeah, in an ideal world, you can time it, but that is not reality. So remember that volatility is a feature of the markets. It's not a problem. It's something to be planned around and not avoided. And that is why waiting for certainty is such a difficult investment strategy. If you sell because markets feel uncertain, you haven't made one decision. You've created a second decision. That is often even harder. When do you get back in? Do you buy while the markets are still falling? Most people do not feel comfortable doing that. Do you wait until the news improves? Well, by then, prices may be already much higher. Do you wait until you're confident that the recovery is real and not a double bounce? Again, markets may have moved well before your confidence returns. That is why the phrase, "I will get back to it when things settle down," sounds reasonable, but it's incredibly difficult to execute in practice. And it's dangerous. There is no bell that rings to tell us when uncertainty is over. Markets are forward-looking. They can begin recovery while the current news still looks terrible, because prices reflect what investors collectively expect to happen next, not simply what happened yesterday. There's another lesson in the long-term data here, one that I think is very important for diversified investors. When diversification is working properly, you're almost guaranteed to be disappointed with something in your portfolio. If the US stocks are leading, you may wonder why you own Canada or international markets. If international stocks are leading, you may question, why was we paying so much attention to the US equities? Bonds, if equity is doing really well and bonds are not doing very well, we can think, why not just be all in equity? Returns are only part of the risk return metric that you're trying to achieve. When we're building portfolios, we are trying to achieve the minimal risk of a bad outcome. And that means that we need to look at all the risks associated with your finances when you're making these decisions. Diversification is not because you know which asset class will win next. Diversification is because we do not know what's going to happen next. A good portfolio is not designed so that every holding wins all the time. It's designed so that your financial future does not depend on correctly guessing what will happen next. And that is where financial planning and investing kind of come together. The goal is not to buy something that never goes up and down. The goal is to build the portfolio while keeping enough stability and liquidity around you so that you're not forced to sell when markets are down, that you're taking an appropriate level of all types of risk. That means keeping short-term spending needs out of equity. It means holding bonds or cash even when they don't feel like the great thing to do, so that you have a plan for when the next downturn in equities arrives. The thing about navigating the markets effectively is that you have to make a really good decision at a time when really good decisions are going to be hardest to make. So building a plan before that happens will enable you to make better decisions more consistently when that hardest time hits. So yes, we don't know what's going to happen next. And the political and market seem to be very intertwined right now. And we don't know. This morning, Trump just announced 50% tariffs on Canada, and how that will impact, how long that will last for, we don't know. We're definitely living in a very volatile time with the markets. But none of that means that your portfolio is failing. It's just very important to remember that you must have a plan for when markets drop. If you don't know what your plan is for the next time markets drop and you can't remember, please feel free to reach out and I'll be happy to go through it with you. Thanks for watching, and I'll see you in the next one. Bye.